So it's another great time, students of CPA. We meet again for this wonderful session, whereby we are going to look at advanced financial reporting. So remember that before I start, I would like to mention that we are heading to August. Almost we are in August, and now this is the time you are supposed to prepare well for the coming exams. So there is that program I'm offering whereby we are doing revision, which I would request that this is the right time you are supposed to join, and we'll do a revision that is in terms of block revision. I think you call it that, the block revision. So for the guys who would like to join my sessions, and I am sure that most of you would be interested to join. This is my contact. Which we can be able to converse on the way forward. So you can use this if you feel free to join, so that I can prepare you well to sit for the coming exams. Anyway, for today's session, I would like to do one question from the November 2017. That is November, not 2017, but 2020, sorry. November 2020 question, question 2B. Question 2B. So this is from the advanced financial reporting. So this is from the AFR, as you call it, advanced financial reporting. A consolidation question, whereby you are told that. So even before I start reading the question, I would request that under the information down here, just click under this information down under this video. You open the link which is there, so that you can be able to follow as I read. So there's a link I have attached, just the information below. You can open, we go through together, because on my case I have the hard copy version of it, so that we can be able to understand each other. So they were saying that H Limited is a parent entity of a group of companies with two subsidiaries. So S Limited and R Limited. S and R. Both subsidiaries have been owned for a number of years. So these subsidiaries have been there for the number of years. And that one implies that in the current year, they will be present for the entire period. So you can see there you have the statement of profit or loss and other comprehensive incomes. We cannot read those variables. You know, it's from revenue up to total comprehensive income as provided. Then additional information, number one, they said that on 1st May 2017, H Limited acquired 75% of the ordinary shares of S, a public limited entity. The purchase consideration was cash of shillings 560, and the fair value of identifiable net assets of S Limited was 400 as at that date. So meaning that the H has acquired S 75%. When an entity is acquired and the percentage of acquisition lies between 51 to 100, so the holding company, which we call it parent, will be calling that relevant investing company a subsidiary. Then they continued saying that the fair value of the non-controlling interest in S as at the date of acquisition was 240, meaning that when you will be doing your goodwill, you have to use full method. H Limited wishes to use the full goodwill method for all acquisitions. So meaning that even for R, you will be given the fair value of the non-controlling interest, or you will be given information which can aid in the computation for the fair value of the non-controlling interest. Because we know that for you to get the fair value of a non-controlling interest, on some cases where you are not given, you will be told that the ordinary shares are fair valued. Ordinary shares are fair valued. They are fair valued. Whereby you will be able to do what? You take the percentage of that NCI times the number of ordinary shares. of the subsidiary, number of ordinary shares of that subsidiary, times what? Times the share price, the fair value of that. So the share price, which share price? Fair value, which will be given the fair value of the shares. So this is how you determine on some cases whereby you are given this information, number of ordinary shares of the subsidiary, which are done what? Which are stated or measured at the fair value. But on this scenario, you were provided direct. Then they continued saying that the ordinary share capital and the retained profit of S as acquisition date were 100 and 200 respectively, and there were no other reserves. So you are given the ordinary share capital. So on the date of acquisition, the equity items, the net assets, the ordinary share capital and the retained earnings is 200. There is no other reserves. Then there is something very important there. They are saying that the excess of the fair value of identifiable net assets as acquisition is due to an increase in fair value of plant. Which excess is this? So what I will do, I will compare my reported net assets. So this is the first working I'm doing, working number 1. So reported net assets, which are given in that additional information number 1, whereby you were told that fair value of identifiable net assets of S was 400. Reported net asset, we have 400. The one as acquisition date, we have ordinary share capital, and what? Retained earnings. So ordinary share capital is 100 and retained earnings is 200. So 100 and 200. So you can see this one is giving us 300. So this is 300 and the reported one was 400, meaning that the excess is the 100 they talked about there. The excess of the fair value of identifiable net asset as acquisition is due to an increase in fair value of plant. So the fair value uplift is that for the plant, which is depreciated on a straight line basis and have a 5-year remaining life. So meaning that I can be able to determine my depreciation here. I can be able to determine depreciation by saying the 100 divided by the 5 years. So depreciation will be 20. Depreciation is 20. So this is my number. Remember that. You can use it for more agreement in terms of joining my revision. So I can put it somewhere here. Whoever wants to join, you can be able to contact me through this number. And without forgetting, I appreciate that we are heading to 10,000 subscribers in YouTube. You have done a great job in terms of subscription. So, and if you have not subscribed, do so in less than 5 seconds so that we can continue. Subscribe, because according to my analytics from YouTube, around 40% of the students who interact with my videos are not my subscribers. So why can't you subscribe? So in 5 seconds, do so as we continue. So I can count 5, 4, 3, 2, 1. So I assume that you have done the subscription. And remember to join my online classes. You never know what we can discuss there, which can help you in overcoming the coming exams. We continue. Number 2, H Limited had acquired 80% of the ordinary shares of R. So meaning that other than S being acquired, R is another company which was acquired. The purchase consideration was 600. R Limited is identifiable net assets had a fair value of 550 million. which was equal to the carrying amount. So meaning that there is no revaluation. R limited is identifiable net assets at a fair value of 550, which was equal to the carrying amount. Non-controlling interests in R had a fair value of 150 as at the date of acquisition. So up to note 2, remember that now we know H had acquired S and R, of which both are subsidiaries. S was acquired up to 75%. R was acquired up to 80%. And we can see both, they said that when I will be doing my goodwill, I use which method? Full method. So I can be able to do working number 2, whereby I can do my goodwill, which is purchase consideration minus share of net assets. Or I can just do in a direct way. I say purchase consideration minus net assets. In a more direct way. So S and we have R. So purchase consideration. So when S was acquired, according to note 1, the 75%, the purchase consideration was 560. Then in note 2, when R was acquired, the purchase consideration was 600. So what I will do here, I will add back what? The fair value of the NCI, non-controlling interest. So both is provided in note 1 and note 2 respectively. So the fair value of the non-controlling interest is, so we can check in note 1, they gave us for S is 240. For R, in note 2, the last sentence in note 2, you are given 150. Then what I will do, I will minus net assets. I will just deduct net assets. So the net assets given as acquisition, remember we do goodwill as at the time of acquisition of these subsidiaries. As at the time of acquisition, they said, note 1, the fair value of identifiable net assets of S was 400. And in note 2, the net assets of R, identifiable net assets had a fair value of 550. 550. So that is the case. So meaning that I can get my goodwill. So I can pick my calculator, then we get the answers. As you also compute to confirm my answers. So based on my calculator, 560 plus 240 minus 400. So this one is giving me what? 400. So this is 400. And on the other side, 600 plus 150 minus 550. So this one we get 200. Now we need to check if there was impairment for the year. Because according to our question, our financial year ends 30th April 2020. It starts when? 1st May 2019. Remember, these companies were acquired some times back, so we need to check in the current year, were these goodwills from the time of acquisition, which are computed based on the time of acquisition, were they impaired in the current period? There's a sentence there. No, there's note 5. If you go to note 5 of the same question, even if I have skipped reading note 3 and note 4, which I will embark later. So let's read note 5. Goodwill arising on acquisition has been tested for impairment annually. And as at 30th April, which is start of the year, because that is the end of the previous year, 30th April 2019. As at 30th April 2019, goodwill on acquisition of S had reduced in value by 15%. And as at 30th April 2020, had lost a further 5% of its original, very important, original value. So, by the start of the current financial year, the goodwill of S had been reduced by 15%, meaning that this is just from the previous periods, that is from the time of acquisition, which we call it accumulated impairment. It's not the impairment for the current year. The 15% of 400 is accumulated impairment, which can affect your retained earnings. If we were to compute retained earnings, accumulated impairment affects that. The retained earnings brought forward. So this is 60. Then now they said that, and by the end of the current year, it had been done what? It had been reduced. Now that is the impairment for the current year, because they said by the end of the current year, 30th April, the goodwill had been reduced by 5% based on the original value. Original value is 400 based on the original value. So 0.05 times 400. So this is 20. So meaning that 400 minus 80, so these are 80. 400 minus 80, that is 320. 320 is my net goodwill. So net goodwill, if I was to prepare the statement of financial position, I record that under the statement of financial position. For impairment, it goes to the statement of profit or loss. I can decide to classify it under the admin expenses, the administrative, or I just record it independently. So note 3, now that is where another story arises, whereby they talked about RE being disposed. There is an entity being disposed there. There is an entity being disposed, which was initially acquired. Remember that we know this. H had acquired which company and which company? S and R. So these companies were there for a number of years. So this one was acquired 75%. This one was acquired 80%. So this is before disposal, before anything happened, before the disposal took place. But now after the disposal took place, there's something they said, note 3, that on 1st November, so meaning that I can go direct and do analysis in terms of time, 30th April 2020. Our financial year starts on 1st May 2019. So they are saying that on 1st November 2019, H Limited did what? Disposed 30% of R. So meaning that after disposal, we have S, which is at 75%, but now R is being disposed at 30. So if we deduct 30 from 80%, we remain with that 50%. And that one implies that this company, which was a subsidiary, is changing to be a joint venture. The percentage has been reduced. So this is partial disposal. This is a question of consolidation, which entails partial disposal of subsidiaries. So 30% of the ordinary shares of R was disposed for a consideration of 375. R Limited identifiable net assets was 675, and the non-controlling interest of R had a carrying amount of 175 as at the date of disposal. The remaining equity interest in R held by H had a fair value of 575 on 1st November 2019. After disposal, H Limited could exercise joint control, which is the 50%, over R. The profits and losses of R Limited are deemed to accrue evenly over the year. Because now here, I will consider R being a subsidiary for the first 6 months, because from May to November, those are 6 months. So this period, R will be considered as a subsidiary. And now towards the end of the period, R will be considered as a subsidiary because it has been disposed. And that one takes me direct to the first first requirement where we were told to look for a gain or loss on disposal of R. Gain or loss on disposal of R. But to be more specific, they said to be presented on the consolidated statement of profit or loss. So the one which is supposed to be presented where? The one which is supposed to be presented in the statement of profit or loss. So what we do to determine the gain. So this is the first requirement as required. But it's a question of November 2020, question 2B. So the gain or loss on disposal of R to be presented in the statement of profit or loss. So we start from proceeds, sales proceeds. So when R was disposed, based on the question given, and then, based on note 3 of the question, the consideration was 375. The consideration was 375. When they disposed that, when they disposed that, they got that one. But now, when this disposal happened, according to this note 3, yes, they made a proceed. They received, that is 375, of which R limited is identifiable net asset was 675, and the non-controlling interest had a carrying amount, that is a carrying value of 175. That is as at the time of disposal. The remaining equity interests in R held by H had a fair value of 575. So when they did a disposal, they remained with some equity interest of 575. So when they disposed the R, there's something they retained. So that is the value to be added back to the proceeds we got. So the fair value of the retained interest. Fair value of retained interest. So the fair value of retained interest, which is 575. So this one gives me 950. Then next, what I will consider here to be deducted, what I will deduct from the 950 is the net asset disposed. I will consider, so let me consider net assets. So when they disposed, remember they sold the net assets. So we deduct that, net assets disposed. So net assets disposed. So net assets disposed is 675. But in this net assets, according to that additional information, the 675 includes what? The non-controlling interest of R is carrying value of 175. So the NCI. So this is the value for the NCI, which we need to deduct. From here. So NCI. So the NCI on disposal. So NCI on disposal is the carrying value of 175. Then now we consider what? Goodwill disposed. So remember that R was disposed and its goodwill now is 200. So 200. So if I do a summation of these items, then I deduct from my 950, I will be able to know if there is a gain or a loss. 675 minus 175 plus 200. So this is 700. So if I deduct, I have 250 being a gain. So this is a gain. So the 250 is what? So that is a gain. So after we have the gain, remember that was based on the additional information which I read. Additional information number 3, the disposal happened. So after that, I went direct to do what was required. It was part of the workings, but that is what they are required us to do for the first part of the question. Then there's the Rust working, I will check there, and we do the presentation of the next requirement of the same question. And I remember this November 2020, this was the only sitting in this year due to COVID-19. This was the year for COVID. That is the period when the exams were done once a year, only November. So still I can repeat my number for the guys who are interested. And I assume that everybody is interested to join my block revision. It's at a friendly price. We do a lot in the live classes where we can interact one-on-one. This is my number. You can talk with me. We arrange on the way of joining. It's true anyway. Commitment of paying, then you start attending classes. Number 4. H Limited sold inventory to S and R. So there's some goods sold at the price of 150 and 45 in the month of October 2019. H Limited sells goods at a gross profit of 20%. So they are goods sold by H. So these goods are sold to both S and R. Selling price 150 and 45. When H sells, he makes a profit margin of 20%. But now we need to look at these companies. These goods they received, did they resell all of them so that they realize the profit H realized? Did they make a resale of this total goods they received? So in that note 4, they said that H Limited sells good at a profit margin of 20%. At the year end, a half of the inventory to S. So a half to S is unsold. That is what they said. A half of the inventory to S remained unsold. But entire inventory sold to R, for the R, had been transferred to third parties. So for R had resold all the goods he received from H. So what am I supposed to do with their half, which is unsold in S? So there's profit unrealized on the goods unsold. So meaning that the profit of H is overstated by what S never realized based on the goods he never sold. So that is what we call unrealized profit on stock, which I need to determine by taking unsold goods times profit margin, unsold goods times profit margin. So unsold goods is a half of the selling price, which is 150, not 500, which is 75, times 20%. In fraction, 20% is like what? A fifth. So this is 10, so this is 15. So due to sales downstream, the profit is overstated in H. The 15 is overstated in H. And it has to be eliminated to avoid profit overstatement. To avoid profit overstatement in H. To avoid profit overstatement in H Limited, we do what? Debit which account and credit which account? So we have to reduce our retained earnings. Group retained earnings account. Group retained earnings account, you debit, you credit inventory. Credit the inventory. That is what you are supposed to do. So far, so good. There's nothing which I have not analyzed. Meaning that is how simple this question was. Everything has been analyzed. So the next thing we do is the presentation. And my presentation will be very simple, straight to the point. Nothing difficult here, because already we have done all the workings required. So now it's very simple to present. In the next around 20 minutes we are done. So we are told to present what? The second part of the question, consolidated statement of profit or loss. So H will consolidate S and R. But now in the income statement as told here, so on this scenario, Remember that based on the consolidation and what's required, what we are going to do is the income statement. So, but now for the parent to consolidate subsidiaries, R must be apportioned appropriately based on the time it was what? It was a subsidiary. Because the parent will consolidate subsidiaries. So that is why you have a control. It doesn't control associates or joint venture, but he accounts for them using the equity method. So meaning that when the parent H will be consolidating S and R, for S it will be considered for the entire year, but now for R it was a subsidiary for the first 6 months. So if I was to do statement of financial position, on this scenario, we could have taken parent, which is H, plus what? Subsidiary only. So by the end of the year, the only entity which was a subsidiary was S. That is for the statement of financial position. But now we are only required to do what? An income statement, statement of profit or loss. So let's do that very fast as we do the relevant adjustments. And we will be done with this question for today. So we can write the heading. So you can do that as a student. Write the heading. So anyway, the heading is H remittent consolidated statement of what? Consolidated statement of profit or loss. Consolidated statement of profit or loss. And other comprehensive incomes. And other comprehensive incomes. So that is for the year. For the year ended when? For our financial year was ending on 30th April 2020. So that is 30th April 2020. So on this scenario, shillings in what? Based on the equation, it's in million. These guys were dealing with 6 figures, millions. So we start from revenue. Revenue. So parent plus subsidiaries. So based on my question, the parent is, this one is 4275 plus 2515 plus now 6 over 12 times R 1730. Under revenue, we always adjust it by deducting intergroup sales, which is there in the 150 and 45 will be done with revenue minus intergroup sales, minus intergroup sales. So cost of sales we take 2735 plus 1445 plus 6 over 12 times what? 1010. So we minus the 150 minus 45 plus the UPS on closing stock which was present based on the goods which were sold to which company? S. And S never resold all of them. There was that 15 plus the depreciation. The depreciation on the fair value uplift of the plant. The excess, which was the excess, remember we got 100 based on note 1. And we did that working. Then 100 divided by the remaining useful life, we got 20. So add that depreciation here. Nothing else to be adjusted there based on this question. So we get a gross profit. Once we have a gross profit, we go to distribution cost. Distribution cost. So for the distribution cost, 305 plus what? 195 plus 6 over 12 times 90. Then we go to administrative expenses. So for the admin expenses, 370 plus 235 plus 6 over 12 times what? 120. Then I can decide to add my impairment here. The impairment of 20. The impairment of 20. That is 400 times the 5%. The impairment can be classified under admin, or I record it separate. Either way, you cannot be penalized for doing that. So that we get the profit from operations. We get the profit from operations. So that when I will be doing my computation, that is what I will get. Then I can see next there was finance cost. So the finance cost, that is 45 plus 40, 6 over 12 times what? Times 30. After finance cost, before I deduct tax, I have to consider if there is any income. There was an income, which is a gain on disposal of R. But R was disposed, and based on the first requirement of this question, the presentation, we got a gain of which figure? So remember, our gain was 250. That is 250. Then any other income or expense to be considered before I deduct tax. So remember that there was a period R was a joint venture from this period here, from 1st November to the end of the year. R was a joint venture. So in this period, the profit this company R made in this period, remember the parent is supposed to get a share of 50%. So that is an income to the parent. So we say share of profit after tax. Share of profit after tax in R. Share of profit after tax in R. But when the time it was a joint venture, the parent is supposed to get a share of that profit after tax. So the profit after tax of R is 380. But now for the last 6 months, times what? 50%. Right? So that up to this point, I can say profit before tax. So profit before tax. So the income tax is, income tax for the parent and subsidiaries, because now for R I have considered it. When I was, as the parent, when I was receiving my share, I have already considered the profit after tax of R. That is the time when it was a joint venture. But now, the time it was a subsidiary, have I reduced my tax? No. So we have to reduce the tax of the parent and subsidiaries. That is when the time S was a subsidiary and R. So the tax given here is all about 160 plus 120 plus number 6 over 12 for R. 6 over 12 times 100. So that we get the profit after tax. Profit after tax. Profit after tax. So after getting profit after tax, I can see there was other comprehensive incomes to be added there. There was other comprehensive incomes to be added. So what you do here, you say add other comprehensive incomes. Add other comprehensive incomes. So shillings in 6 figures, which is millions. So add other comprehensive incomes, which is a gain on property revaluation. So on this case, we say 150 plus 6 over 12 times 80. Then we say total comprehensive what? Total comprehensive income. So, but remember, after getting the total comprehensive income, and also we have a profit after tax. So the profit after tax must be shared to minority shareholders and the parents. The same way, these total comprehensive incomes will be shared to the parent and NCI, the non-controlling interest, the minority. So here I would say profit after tax, attributable to who? Attributable to NCI and parent. So this one, which I will be able to compute and know which value is that. Then total comprehensive income, the total comprehensive income attributable to NCI and the parent. So also I need to know this one, which I will share here. So what I will do is the computation. So let's compute. We need to get these figures very fast. 4275 plus 2515 plus 6/12 times 1730 minus 150 minus 45. So the first one is 7460. And now we deduct what? Cost of sales. So the cost of sales is 2735 plus 1445 plus 6/12 times 1010 minus 150, which is intergroup sales, minus 45 intergroup sales plus 15, and realized profit on stock. To be more specific, on the closing stock, which was unsold by S, plus a depreciation of 20. We get 4525. So 7460 minus the answer. This is 2935. Then 305 plus 195 plus 45. So this is 545. 370 plus 235 plus 60. Because half of 120 60 plus impairment of 2685. 2935 minus 545 minus 685. That is 1705. Then 45 plus 40. 45 plus 40 plus 15. This is 100. So this one we deduct, this one we add. The gain, you add. Remember we did a working. And this was the first requirement. 380 divided by 2. That is 190. 50% of that. This is 95. So if I take 1705 minus 100 plus 250 plus 95, I'm getting 1950. That is profit before tax. 160 plus 120 plus 50. 330. My good students. 1950 deduct tax. Profit after tax, we have 1620. 1620, 150 plus 40. This is 190. So 1620 plus answer. That is. But now remember that this one was for S, not R. So this one was not apportioned. So it was 80. Remember, it was H plus S, not for. We don't have revaluation for R. So meaning that 150, so rectify that. So 150 plus 80, 150 plus 80, that is 230. 1620 plus the answer 1850. So this is what will be shared here, 1850. The total comprehensive income attributable to this and this. Then the profit after tax 1620 will be shared here. So profit after tax attributable to NCI, profit after tax to NCI will be, so will be which figure? Remember that NCI is both in S and R. But in R, remember it's for the last 6 months. Not the last 6 months, but the first 6 months. So meaning that the profit after tax, we start from profit after tax of S and R. But remember for R, you have to consider for 6 months. So for S, the profit after tax, based on my equation here, profit after tax is 480, 480. Then this one is 380. But now 380 divided by 2, because it's for 6 months. That is the time when S was a subsidiary. Because NCI is the percentage unacquired in subsidiaries. So R was a subsidiary for the first 6 months. So meaning that 380 divided by the 2, that is, or you say 380 times 6 over 12, you get 190. I consider this profit overstated or understated based on the items I will check if they are available. If there's UPS upstream, it means that these profits are overstated, but the sale was downstream. H sold to S and R. We don't have that. Sales upstream is not there. Depreciation is there based on the fair value uplift for the plant. So there was that depreciation of 20. Depreciation of 20. So that one is deducted because it was based on a fair value uplift. So meaning that they had not adjusted the 20 on this profit, the depreciation, based on the fair value uplift of the plant. Another thing is there another item? Impairment. Or if there is depreciation overcharge, we don't have overcharge because there is no sale of any fixed asset. If there was a sale of fixed asset, that is when we could have gone ahead to check for depreciation overcharge. Then there is impairment. But the impairment is always considered if we considered full method in goodwill, of which we did goodwill and we considered full method based on the NCI fair value provided. So our impairment was for S only, and I remember well it was 20 for the year because it was 5% of the original value of the goodwill we got, which was 400. So meaning that this one remains to be 190. This is 440. So I need to apply 25% on this. Then I add with 20% of this for me to get what is going to the NCI. So on this scenario, 0.25 times 440 plus 0.2 times 190. So this one gives me 148. So if I take 1620 minus 148, so that is 1472. So I have just, for me to get this, I have done this, 1620. I have deducted 148 from there. Then now to get for total comprehensive income, the profit attributable to the NCI based on the total comprehensive income, what we do, we take this 148, so the one which was attributable to the NCI based on the profit after tax, plus, remember we have a revaluation here, 150 and 80. So this 150 goes to the parent. This is for the parent. But for 80, there's a share for NCI. So 25% of the 80. So that one will be, so 0.25 times 80, that one gives me 20. So 148 plus answer, I'm getting 168. So what about what goes to the parent? So I will take 1850 minus 168. So 1850 minus answer. So this is 1682. We are done with the question. We are done with the question. So in this question, the examiner was in need of how many marks? 16. Only the statement of profit and loss required 12. So they can say, marking, mostly they say right now, the 12 marks, they could have been in need of any 6 entries, any 6 at 2. So you get your 12. So there are some few items which are direct. You could have scored. The one which doesn't need a lot of adjustments. Right now, distribution was direct. Finance cost is direct. Income tax is direct. Those are already 3. Those are the one which doesn't need any adjustment. Even admin, it's only that this one you could have went ahead to check for impairment. So anyway, you can be able to see how you are required to do this question. So this is a question whereby the subsidiary has been disposed partially, and it changed from being a subsidiary to a joint venture. We call it partial disposal of subsidiaries. These are assets held for sale, not discontinued operations. Yes, students, this is what we do in our interactive sessions, the live classes, which I request that you do the necessary by joining. I do evening classes. Right now today, I will be introducing group accounting from scratch. That is from the introduction part of it, even before we do questions, from 8 p.m. today and tomorrow, the advanced financial reporting. That is what I will be doing. Then we do around 8 questions for us to cover the concepts of consolidation from the advanced level. What are you waiting? Just join my classes and we do interactive sessions. So remember that I have already shared my number for the guys who would like to call me in terms of joining my classes. Remember, for the guys who are outside Kenya, because I teach guys from Rwanda, I have guys from Tanzania, Sudan. You know, you have to put the country code before the number. So my number is this. Because I saw some comments that there are people who doesn't know how to reach me so that we can assist each other. So do the necessary, and I appreciate for your time, and make sure that you subscribe to my channel so that we can achieve in the coming time we get to 10,000 subscribers and more. Thank you. Welcome for the Zoom classes, and also welcome. We do great in terms of preparing towards August exams. Yeah, that is okay. That is okay. We have come to the end of the session.